Hello and welcome. You've tuned into Business Lunch. I'm Nisha Podar, and with me as always is Sonia Shenoy. Sonia, good afternoon. A good day in the markets today, and Nifty 50 really revving up at this point. Almost 100 points gain for Nifty 50, 11,140 odd levels. In fact, it's the bank, Nifty Bank also, which is giving equal amount of support to the overall market. So the key indices are performing well. Mid-cap index also gaining above 0.5%, but still underperforming some of these key indices. Now, Reliance Industries, if you really take a look at that particular counter, is the key and the largest contributor today on Nifty 50. And take a look at the 7-day chart of Reliance Industries. It carries on with the gain and the momentum that it really caught on to after the AGM announcement. So that's a good thing. And Kotak above 1500 levels is also a very good sign. It's bounced back above that level and is not too far from 52-week highs as well. Z in the last few minutes has really shot up. Keep an eye on that. And Yes Bank has really seen some bit of pressure in the last few minutes of trade, Sonia.
Yes, in fact, since you've summarized the market opening as well as, what the key stocks are, I'm just going to put one thing on the table. It's actually a global rally that has taken our markets up today. As we speak, most of the Asian markets closed with 2% gain. So we're not alone in this up move that we've seen. Of course, global markets have been under a lot of pressure in the last 1 week or so. But today, there is an up move that we're seeing. Look at Hang Seng now up almost about 600 odd points. So it is a global-led rally. The most important bit is whether it sustains through the course of the day. Because for now, it has been a sell-on rally market. That's the strategy that has worked. But today, it seems like, things could be a bit different. I just want to point out that this month has been very strong for a lot of the auto names. So names like Maruti Suzuki, Bajaj Auto, even Hero MotoCorp are all up about 5 to 15% this month. So maybe, just maybe, perhaps the worst of the price damage is now behind us. But here are the list of the top stocks in focus. Sun Pharma has been gaining after the US FDA classified the Halol plant as a no action indicated.
Next one is Ujjivan on our list, and shares under pressure after it filed a DRHP for its small finance bank and worries about a holding company discount leading to a decline in the stock price.
And the new listing, Spandana Spurti, fails to cheer Dalal Street. The share prices slip below the issue price.
Let's also take a note of Coffee Day Enterprises, and the shares zoom after the company says that their group debt will reduce by 2,400 crore rupees post the sale of the Global Village Tech Park. All right, so a host of brokerages, remember, have been downgrading the earnings estimates post the Q1 FY20 earnings. In fact, that's a big worry on the markets, and Nimesha is right here with all the details of that development. Nimesh, tell us.
Hi, Nisha. So, not highly unexpected, but this is something which was pretty much, expected that the brokerages cut will come post the Q1 week show. So I'll start with CLSA first. They said the earnings downgrade has been across the board. The earnings downgrade has been 55%, which is 3 times more than the earnings upgrade, which is just at 19%. So the ratio is 3:1 in terms of upgrades to downgrades. CLSA has cut the Nifty estimate for FY20 and FY21 by 5%, and the consensus is down now by 3 to 4%. Still, CLSA expects 18% earnings growth for FY20 and close to 21% earnings growth for FY21. Motilal also believes that there is a risk to the downgrade. Risk has elevated post Q1. They have cut the EPS by 4%, and the downgrade upgrade ratio is close to 3x for them as well. They still expect the Nifty EPS of close to 16.5% for FY20 and close to 19.7% for FY21. Even ISEC has put out a note today morning. They've cut the Nifty 50 EPS by close to 2.5% post Q1. And even they said that the upgrade to downgrade ratio is close to 3x post the Q1 numbers. This is something where 4 to 5% EPS cut has already come in. But the bigger challenge is still for FY20 and FY21, the broader consensus estimate is close to 16-17% for FY20 and close to 20% for FY21. Remember, for the last 4 years now, we've been working with a close to 20% earnings growth, and we end up less than 10% every year. So there has been massive earnings cut for last 4 years, and that seems to be the trend this year as well. Given that Q1 was weak, I guess everybody is going to miss the estimate 16.5% for FY20, and of course, it's a tall ask to achieve 20% earnings growth in FY21.
Oh, absolutely. Thanks a lot, Nimesh, for that. So earnings growth forecasts have been lowered for FY20. But on to important events today. The task force is slated to submit the report in the afternoon. Remember, a report will be crucial with respect to suggestions on LTCG, DDT, income tax and more. My colleague Tim C, who's been tracking this space very closely, joins us with a quick heads up. Tim C, what can one expect?
Well, as you rightly said, the task force on simplification of direct tax legislation is all set to submit its final report to the Finance Minister Nirmala Sitharaman today around 3 p.m. Now, government officials have indicated that the report, which is going to be the vision document for the future of direct tax policy in the country, runs into over 200 pages, and it will also have a draft bill of about 400 pages enclosed. Now, just to remind our viewers, the task force was first set up in November 2017 after Prime Minister Narendra Modi observed that the present law was more than 50 years old and needed redrafting to make it contemporary in nature. Those who watch the direct tax policy space closely are expecting that the report might recommend changes in the current personal income tax slabs. It is also likely that the report may lay the roadmap for corporate tax reduction. It is also expected that it will have a view on the LTCG and DDT. The terms of reference recently added that it had told task force to suggest changes to making the current law in sync with global best practices, suggest ways to reduce litigation and propose new measures for reduction of compliance burden, and a lot on the table. So let's see what finally unfolds in the report. We'll keep you posted on it.
All right. Thanks so much, Tim C, for getting us the heads up. But any let up on the tax pressure on the corporates will be taken with both hands. Now, as global economic slowdown signs really gather pace, Lata Venkatesh caught up with Raghuram Rajan, the former governor of the Reserve Bank of India, to get his outlook on the issues, and began by asking him on his thoughts on India's growth estimates being brought down.
There are a variety of growth projections from the private sector analysts, many of which are below, perhaps significantly below government projections. And I think that certainly the slowdown in the economy is something that's very worrisome. You can hear business all around worrying and complaining out loud that they need some kind of stimulus. But I also think that we should pay attention to some of the arguments made by the former chief economist, Arvind Subramanian, that in fact we may be overestimating growth with some of the new GDP data. And I would suggest that we, and I've been saying this for some time, we need a fresh look from an independent group of experts at the way we compute GDP and make sure that we are not, in a sense, having GDP numbers that mislead and cause the wrong kinds of policy actions.
What about the nature of the slowdown? Is India in a structural rut? Do we need something like a redux of 1991 reforms?
I have been saying for some time that I really do think we need a fresh set of reforms. And we need a fresh set of reforms informed by a view on what we want India to be. And I would love for that view to be articulated at the very top. Here is the kind of economy that we want. One-off programs here and there don't amount to a comprehensive reform agenda for the economy. What we call reform, borrowing in international markets, is not really a reform, it's a tactical action. What we really need is an understanding of how we are going to propel this country by the 2 or 3 percentage points greater growth that it needs. And that needs fixing the immediate problems, such as in the power sector, such as in the non-bank financial sector, and those need to be done yesterday, not in the next 6 months. It's very important that those be tackled immediately. But we also need a new set of reforms which energize the private sector to invest. SOPs, stimulus of one kind or the other, are not going to be that useful in the longer term, especially given the very tight fiscal situation that we have. Instead, bold reforms, well thought out, not jumping off the cliff, but really seriously thought out reforms in a variety of areas which energize the Indian people, energize the Indian markets, and energize Indian business. This is what we need today. And I really hope we put our best minds to think about this, because absent that, my sense is we're in for not so good time.
Okay, well, on that cautious note, let's take a quick break. As we do that, here's a look at the top stories on Money Control Plus.